Markus Schomer is a Bloomberg Best economist on existing home sales from Pinebridge Investments. He joins us today in studio. You thought that the consensus was too optimistic here. You didn't expect a number this bad.
No, nowhere near as bad. But to put things in perspective, Margaret, we shouldn't forget this. This reflects decision taken in May and maybe early June.
Right.
So this is much more of an echo of the fact that the first-time homebuyer credit expired at the end of April. And we shouldn't forget that new home sales declined 32% in May. Pending home sales declined almost 30% in May. And this is more or less the same kind of effect that we're now seeing in the existing home sales numbers.
So you say that only because the information is possibly lagging. Do you expect then that there was a build in the more recent months?
I would not think there's going to be much of a build. What I expect to happen is over the next few months is that sales, both new homes and existing homes, will go back to where they were in the 12-month period before the first-time homebuyer credit came in. I'm not looking for a significant boom here in the second half at all, no.
Well, there was a lot of apprehension before the numbers crossed. We've come off the lows of the session in the equities. But I point that out because there was a lot of fear about this number. And there was fear that what we would see with existing home sales would somehow confirm last week with the fear that manufacturing is slowing down. And that's what we saw with the Philly Fed figures.
Yes.
Is the recovery stalling?
The recovery is slowing. I wouldn't say stalling. Growth forecasts across the board from most economists have been coming down. They're probably not down enough. I think the U.S. economy will grow about 2% in the third and fourth quarter. But stalling, I think, would imply something more serious than that.
So when you're looking towards the end of the week and the GDP figures that we are going to be seeing there, you're still seeing growth of the 2% level?
Well, my forecast is 1.9, so maybe technically I'm close. I'm not as bearish as the consensus, but again, put things in perspective. Don't forget the revision that will come at the end of the week will not mean that we had less demand in the U.S. It would just mean we outsourced more to the rest of the world. The strength of consumption, the strength of investment, the strength of government spending will most likely be unchanged. All that will change is the fact that imports will have grown stronger, which means the rest of the world benefited more from the U.S. growth than the U.S. itself.
Well, when we look, though, at the figures, Mike McKee, our economics editor, points out that with the numbers we got today from existing home sales, foreclosures were 22% there, short sales up to 10%. The expectation there that perhaps this is going to lead to further home price decline, that's going to bleed over to the consumer. Why are you not more worried about that?
Well, home prices, housing prices, I wouldn't even say they have increased, but if you look at the last 12, 18 months, home prices have really been fairly stable. There's been a bit of an increase in the Case-Shiller number, which focuses more on the subprime market, but home prices in general have been fairly stable despite the fact that sales have been incredibly volatile. So I don't expect this decline to lead to...
But you're not expecting an increase in prices here.